I started with smaller projects, and then I realized, well, if you go to the notary once or you go for 10 doors, it comes to the same thing. And I mentioned this in the last podcast. It's the same amount of effort and work to go to buy 2 doors than it is to buy 20. So why not take, things into your own hands and scale into 20 doors and plus? That's kind of where I focus, and I get the best return on investment in that space.
Hello, and welcome back to the Very Real Estate Effect podcast, a show dedicated to real estate investing right here in Quebec. And today I am very honored to have 3 real estate investors from Quebec. Some of them already know them because they've already been on the show. So just to do a quick roundtable before we get into it, today we have Alex Rossi, we have Stephanie Kowalew, and Uriel Bigot, all of them, and myself, of course, all real estate investors here in Quebec. And we're going to have a fun end of the year 2022 episode. It'll be a bit longer. It'll be jam-packed full of fun tips, fun experiences that we've had. And the point is for all of us to share what our year was like. But before we get into this, as usual, I just want to remind all of you, thank you for supporting the show. Thank you for leaving us a comment, subscribe, share it with a friend. And as newly announced, we've also launched a Patreon page, so you can keep supporting us. And if you want to become part of the family, become a family member or an inner circle member, you'll get quite a few privileges, advantages. And I invite you to go and check it out on patreon.com/realestateeffect. Now that we're here, and before we get into what we did in real estate in 2022, let's just do a quick roundtable because all of you have been on the show before, but not everyone may know you. So Alex, starting with you, who are you? What do you do?
Well, thanks for having me back, Axel. I'm Alex Rossi, the Prince of Pre-Construction. I've done everything from, condos I started in Griffintown up to bigger projects in the Gatineau area, and I focus solely on pre-construction. That's my forte. That's what I love helping others, invest in, and that's where I see a lot of opportunity to help people build wealth in that space.
Nice, thank you.
Yes, so my name is Stephanie Kowalew. I'm the founder of Effet Papillon Financement, and basically we help clients use leverage effect through their multi-unit projects to keep growing and become bigger and bigger. And I also invest on a smaller scale in real estate projects.
Uriel Bigot, multifamily investor, mostly in used but also new construction in Quebec. Starting also to look into the US market. I'm also the founder of La Fabrique, where we help immigrants acquire wealth through real estate and helping them grow and take advantage of what Quebec has to offer when it comes to the real estate market.
Nice. So we have all a bunch of entrepreneurs. I won't introduce myself because I've done it too many times over the last 2 years on this podcast. So let's get right into it. 2022 has been a bit of a crazy year, and we all had different experiences. We all focus on a different type of real estate investing. And the idea was kind of do just a round table of what we went through. And I'll be happy to start because now that I think back, even at mid-January of this year, a lot of things have happened since then. And did a few projects. I learned tons, but a project that I'm really happy about is a purchase of land in Saint-Jérôme, first construction project. I've talked about it in other episodes, so you're welcome to go back into time. We've also done an acquisition with my friend Simon. We're still working on that, not on the acquisition, but on the next steps of that project. And mostly in 2022, and then I'll let you go with it, Alex, is that I feel like I've really learned tons because I've really stepped out of my comfort zone in trying to tackle bigger projects. And I know it's been a big motivation. I'm happy to do triplex and sixplex and stuff, but I want to get out of the onesies and I want to do bigger buildings now. So that's been one of my things in 2022. What about you?
You nailed it right on. I mean, I started with smaller projects, and then I realized, well, if you go to the notary once or you go for 10 doors, it comes to the same thing. And I mentioned this in the last podcast. It's the same amount of effort and work to go to buy 2 doors than it is to buy 20. So why not take, things into your own hands and scale into 20 doors and plus? That's kind of where I focus, and I get the best return on investment in that space. With the new program, MLI Select, we've all been talking about it since March, just when rates went from, 1% to 4% overnight. Do you remember that?
Yeah, slightly. Not overnight, in a period of a couple of months.
Like it came right at the opportune time,
Yeah.
The new program was launched, and like within 72 hours, rates overnight had just skyrocketed high. So, the good news is that it had aided what we saw in such a rate hike, and it's kind of facilitated new build and new construction, and at the same time people are able to still refinance by making housing affordable, accessible, and eco-friendly. So I think that was probably the biggest roller coaster we saw this year. We saw rates hike the fastest pace since I guess the 90s, and then we saw the introduction of a new program which kind of combated the the damage done from rate hikes that none of us like. So
yeah.
Super. That's what I like the most about this group of investors, that we're kind of at the same level where we're like, we want to go big and we're in this transition. And I kind of feel the same way. So that's one of the highlights of my year, is just really going bigger. In terms of the reality of the market, I mean, it's been really tough, but I've come across with financial services, like we have so much demand for brokerage services, because for the first time in 20 years, people are going to their bank and they're being refused. So I think the highlight of Effet Papillon this year is just building your relationship with clients we would have never had before, because they were well served by their banker, and now they're no longer well served by their banker. So it's a huge opportunity for us, and we're taking advantage of it. So it's been a good year for us in that sense.
And I want to piggyback on that one, because I think back then, almost anybody could make money in real estate, right? When you get a rate at 1%, any fool can make a killer by just buying anything and just refinancing at a higher value. Now, I think the market is kind of weeding out those who don't really know what they're doing. And the biggest thing for me this year was also going bigger. I was all finishing 2 construction of 2 8-plex. I have 2 other coming up, but then I moved to a really, really larger game by acquiring a big land in Lévis, where I should be building around 300 units. So that was really like a stepping stone for me. Mm-hmm. But then that was also a emotional roller coaster, because your numbers are extremely good on paper. Then you see the rate hikes and you're like, it's not working anymore. And then you have to come up with new strategies and adjust and be more, I would say, creative about what kind of services you want to offer. And that goes through the MLI Select program, by understanding how you can leverage eco-friendly building, how you can leverage affordability. Like, it was never a question for most of us, except you, because I think that's really your strength, to include, I would say, lower rent in our buildings. But now it's kind of a no-brainer. You have to go through that, because it opens so many doors when it comes to the financing of it. So for me, the big thing was really going bigger, just like we all mentioned, but also seeing more opportunities, because now sellers are more cautious. Sellers are really more open to negotiating prices. So honestly, yes, rate went higher, but now we have a market where buying became really easy. Yeah. So that's the big thing for this year.
That's true. Like, as you sum it up until a little while ago, you could just buy anything, wait 2 years and make money with it. And now things have changed, the economic environment. And 2022 has also been the birth of the MLI. Now, the CMHC had it in their stomach for quite a while, but they finally gave birth back in March, and that's when it started. And actually, no.
I'm just going to ask Steph, how much was invested in that program? Let's talk about the amount of time and the amount of resources and the capital deployed to launch this program. They didn't do it overnight. And I'm probably not the best to comment on that, but I believe Steph would have more insight to share on that. That's a biggie.
Yeah, I mean, in terms, they already had an affordable program, so they've been working towards just this new program. In terms of resources, I mean, they had before the RCFI, where that was funds by the government, but this new program, in terms of the resources that must have went into it to also foresee what's coming in the market. I mean, new construction is important in a market where demand is so high. So they really saw clearly. But in terms of the resources specifically, like, I have no clue how much went into it, but I know they've been developing over the past year. They had a specific affordable program before, but now they really included, I think, also with political push, energy efficiency and accessibility to bring it back to code. So a wonderful program to be using. We're talking about MLI Select or APH Select for the French side.
And the thing is, I heard about it last year around this time of the year. We were kind of closing on 2 projects we were building. And it was like, let's go the regular route. Nobody knows how it's going to work. It's pretty new. And it came out in March. And it's funny because today we still talk about MLI Select and the CMHC regular insured loan, but the reality is that now MLI Select is kind of the new, like the old one.
It's the new standard already.
Yeah, because with rate hikes.
And who wants to pay 4% premium when you can pay 1%
Exactly.
and just do,
And now, like the way you can even get a longer, amortization, you can get like, your DSCR can be reduced. All those things makes it that it's going to become the new norm. And that's really transforming the market. Because now you have to keep these things in mind when you renovate a building. You have to keep these things in mind when you plan on refinancing a new building. So I think it came at the right moment on the market where we really needed it, because there are so many projects that was closing where they were no longer working, right? Because no matter how much you plan for risk, if you do your math on 2% and you go to 4%, it's
Nothing works.
It's a catastrophe, right?
Nothing works when you double rates like that overnight. Nothing.
And we're talking about think about the $100 million projects, like they're coming at the end of their construction. They can't even pay off the construction loan to convert to long-term. They have to put in millions and millions of dollars to close on a CMHC loan. Like it's unheard of, So it's like the scary part, but then the other part is the opportunity that creates in terms of buying opportunities. But it's an interesting market to be in, and I think what scares me a little bit is just the demand that's not stopping and the offer that's not necessarily going up anymore because the liquidity is not there anymore.
Yeah.
And even the worst thing about this is we can see it now with the banks. Even when all your numbers are good, they're still reluctant a little bit because it's not so much they don't believe in the project, especially when you're doing construction, right? There's going to be 6 or 12 months between the moment you secure your bridge all the way to the moment you put your final financing in place. So they are so concerned about the volatility of the rates that they will ask you for more and more warranty. They will ask you to put more and more down payment because they are just scared, right? Nobody knows where the market is going from a rate perspective. Yeah. Everybody's talking about a recession next year. So what I notice in the market is that the banks tend to be more cautious about giving money to people because there's so much unknown.
But I feel like it's already too little too late because we're seeing cash calls on construction project where they overstretched it, and now like in the 90s, way back when, they had to refinance, but because debt service coverage was no longer capable, they had to make cash calls where the person to renew their existing mortgage had to put down $50,000.
Does CMHC
Obviously,
still enforce?
CMHC, in my opinion, I don't think that's going to, because it's insured. So I think if you pay your mortgage and you follow policies, it's fine. But for conventional mortgages, that's what scares me. Because the CMHC insured, we're good, we're covered. But conventional, if the debt service coverage is not there, how are the banks going to react to that? We're seeing cash calls on construction projects.
Yeah, and do any of you have had the bank call them at a renewal to ask for to go interest only, no principal payback, or have you had to inject some capital and stuff? Because I have 2 people I know have had the call from the bank exactly for that, and so I was kind of bracing, nothing yet, and we're all good in that sense. But I can just imagine how people are starting to get scared.
I have a 9-plex where I was supposed to refinance this year. And we went we bought it, we optimized it, we left it on the conventional loan because we were able to pull out all the money we needed with the conventional loan, and the other was to wait the next year to do CMHC. And my rate is going from 1.95 to 7.1. It's brutal.
Yeah.
It's extremely
That's very brutal.
The good news is that it's a building where I have a lot of cash flow, so I can take that heat. Mm-hmm. But obviously, I'm going, variable. I'm just waiting for the rate to drops, and whenever we can, we're gonna put a long-term debt on that with an insured loan. But that's it's scary. It's scary. If you are not well prepared, if you don't have deep pocket, it's gonna hurt. We're talking about opportunities, but that also means some people someone's opportunity usually mean also someone else, issues, right? You better be really well capitalized right now because it's gonna hurt.
Exactly. And I think that in real estate, people look at themselves on a paper-rich basis, but this is all about debt service coverage. The crisis we're going to face is all about debt service coverage. And yeah, it looks good that there's $1 million in valuation, but you can't finance it. So you're not worth anything, really.
Unless you sell it and cash out.
Which is in a
But it's
bad
tougher to sell because they're
Exactly.
rounding their numbers too with a higher rate, and
what-
they're looking around and they're like, "Well, I don't qualify. I'm not going to pay a mill that you think you're worth, and then I'm not going to take on that risk." So,
And it circles back to what you were saying, where like you're going to see the real guys and
Yeah.
women like just progress in real estate, those that were cautious and understand how it works and are not stress testing based on 20% increases year over year. Like those who got in like in the past 2 years, they didn't see the real estate,
And then that's really what it is. Like the last 2 years were kind of an anomaly.
Yeah.
Because
Yeah.
we're buying like left and right. And when I started investing, I think it was 2019 in multifamily, I was buying at $80,000 a door in Sherbrooke. It went all the way to 110,000, and it was still okay because the rates were low. Now, if you buy,
Now it's 150.
now it's starting to drop a little bit back to 100. But if you buy anything above 100 with the current rate, you're gonna be dropped dead. So
Yeah.
I think the market is just readjusting.
Yeah.
And I think people are forced now to be cautious about risk management. That's what it is at the end of the day. How well are you managing your risk? How well prepared are you to get some more hits when it comes to the rate increase? But also, now we haven't started seeing it yet, but there's also a question about if we hit another recession, all those high value, the rent, I have rents in 1,400, 1,500, will people still be able to pay those, right? Or even better, will the rate go higher, the rent go higher because there's a shortage in the market, right? So I think next year is going to be really interesting, but you have to be in the market to really get that experience.
Actually, I'd love to talk about that a little bit on the rent side because I kind of have like the two extreme. I have some small units in Lachine that are for like $900, and then I have some other ones in Verdun that are 2 bedrooms for 23, and there's a lot of spread in between. But one thing for sure, though, and I'm an immigrant here. I'm an immigrant in Canada. I thank Canada every day for the opportunity it gave me, and it's going to continue to be a refuge. And just from the immigration standpoint, we have like 420,000 visas for this year. No, in 2022, we're going to get 450 in 2023. I don't want to say hallelujah. It's just that we all know that demand is going to keep pushing really hard. And with the effect of the interest rate increase, there's less new supply. Like I think the mise en chantier has stopped by like 40 or 50%. So now there's half the amount of new dwellings, and we're short tens of thousands every year. So how do you guys feel about the next year from your rent increase point of view?
I'll say two things actually. What I'm noticing and what I'm seeing is it's very difficult for new builders to get permits to start building just because it's a lengthy process.
From the cities?
The area in which I develop in Gatineau, it's very, it's a lot of bureaucracy. There's a lot of red tape involved. So it projects can take up to 2 years to get that final approval. So even if we have a ton of immigrants coming in and we're like, we got to build, if they're not getting those approvals for 2 years, well,
yeah.
Your rents are going to climb if people are coming in. It's just a question of supply and demand, right? So that's definitely a challenge that I'm seeing right now.
Mm-hmm.
I know these two things. So my personal belief is that rent will increase. The reason is simple, like you mentioned, there's so much demand increasing. And don't forget also about all those, I will call them wealthy renters, people who can no longer buy, right? Because the rates are so high now. And just the overall, feeling about the economy, people don't want to buy anymore. They rather rent, and they're going to rent something really more expensive. The second thing I also notice is that the cities, yes, they're extremely, extremely slow when it comes to giving permits. But what I notice is that now they are more and more open to higher density.
Yeah.
I'm currently working in Lévis, where we were almost told by the city, like, guys, this is not big enough. Like, you want a major avenue, add some more floor on that stuff. And they don't really have the choice because at the same time, we're talking about climate change, right? We don't want to expand too much. We don't want to eat too much of those nice land. By the way, Quebec has some of the nicest land where we can, grow crops. Laval is a good example, right? It's only buildings now, but still. And we don't want to expand too much, right? But if you don't expand too much, if you don't want to go too much horizontal, you got to go vertical. And I think that we're going to have more and more openness to have higher density. So my strategy is to buy land, and buy land, because the demand is increasing. Cities want to increase the density. So all those together, it's a good sign for builders.
And are you noticing challenges with building on that land? Are you getting pushback with, the cities, with developers, with...
So with the city, it's a lengthy process, right? You got to go through so many different levels of approval, between the moment you submit your concept all the way to the moment you get your permit. It's a really lengthy process. What I'm seeing was more on even on smaller projects, it was really hard, I would say 6 months ago, just to get trades, just to get people to come see and give you a quote. I had people telling me, well,
you need to pay for the quote.
I called someone to come demolish. This is a small triplex I have to demolish in Hochelaga to build a new one. And I called a guy to come, give me a quote. And he came, give me a quote. Then I called a second guy, and that guy happened to have called the first guy I called. And then when he realized that, well, you're shopping around, and he told me, because you are shopping around, I'm not going to give you a quote. I'm like, that's my job to shop around. That's what I'm supposed to do. And that's where we were. They had so much job, so much work, they didn't care. Now it's different. Now they're calling you back. Hey, that job that you called me for last week, is it still available? And I think, once again, this is the golden age of construction, because rents are going up, value are going up. Yes, rates are high, but I'm starting to see a drop in the construction cost. And I think those two balance is going to be a good year for construction.
And maybe, Stephanie, you have data about this, but on the construction cost, is it pre-2020 or is it just going back down to where it was 2020, 2021?
I mean, it went up significantly. We're talking almost like double the prices. So I think it's going to go back to probably pre-2020, and mostly like the trades are probably where the balance is going to come, because they've been so in demand for so long that they always had, like, I think it was one of my friends, he was saying, I forget if it was Manitoba or Saskatchewan, but it was a large scale project, but we're talking about millions and millions of dollars in price revision. In terms of construction costs. It's incredible within a span of a couple of months, so that's good. That's good. I think it's fair, and I just think that's going to be good. But I would assume somewhere around pre-2020, but it's doubled since then. So closer to like normal.
And also materials, right? Wood just increase, and all those are kind of coming back now. So I think there's a good window now to really take advantage of all those things.
Unless rates jump up another 100 basis points and all our hopes and dreams.
Stop. No. But as you said, like, hopefully in 2023 things will come down a little bit. And we'll have a perspective for 2023. We'll get to that afterwards.
But there's still a labor shortage. So that's kind of where I'm just like, is it realistic? That's where I'm kind of skeptical a little bit.
That's also how you look at it, because yes, there's a labor shortage when it comes to trades to build your building, but there's also a labor shortage in companies, in small medium enterprise. And what do they do when they have shortage? They go abroad. I'm good example of it. You are as well. We are both immigrant. Canada has a goal to reach 100 million inhabitants by 2100, right? That's Trudeau policy to make sure that we increase the size of the country, because look at USA, 350 million people, roughly. Canada, 35, I think 38 now. So to really be a force, and also just to have a per habitant investment in things such as war and army, you need to increase your population. And Canada has been extremely good at bringing in people who are educated, that can start paying taxes right away, and who are used to pay higher rent. Like, I was paying 1,000 euros for a 600 square foot in Paris. I came here, I was paying 1,000 Canadian dollars for 1,200 square foot. So we are accustomed to paying higher rent. So when immigration always drive pricing up when it comes to rent. So I think this is that shortage will be addressed through also bringing more people in that need housing. So I think it's an opportunity.
And Quebec is also an interesting example because if you compare obviously to Vancouver and Toronto, like rents are already way up, but there's a language barrier that protects Quebec in a way that is super interesting for those investors in terms of cap rates compared to our neighbors. It's just next level. I mean, we're in Gatineau investing and we're talking about a 50% rent decrease almost on
Relative
the same
to Ottawa, you mean, or
exactly
suburbs
so
of Ottawa.
It's like
You say 50% rent
Almost, yeah.
decrease?
yeah.
like a
Shorter.
comparable. Let's say you have, I don't know, a 2-bedroom in Ottawa, like
Oh,
$3,000. It'll probably be like $2,000 or $2,200. We're talking 40%
Yeah.
decrease.
Yeah.
30,
Just for a
40%.
comparable within,
Okay.
let's use the same radius, like 10 kilometers from Ottawa
Yeah.
Parliament to Gatineau, or 10 kilometers Parliament,
Yeah,
elsewhere.
yeah. Okay.
You're looking at it the same.
Okay, I totally misunderstood. I thought you were saying that you recently had a 50% drop in rents in Gatineau,
No,
and I was
no.
like,
Oh,
oh my
no.
God.
Like compared
Run,
to
yeah.
Ottawa prices,
Yeah.
it's about
My building
30
is
to
worth
50%.
half.
Yeah, no, across the river, the comparables.
Exactly.
Okay, yeah, makes sense.
Which does signal that there is opportunity in that market too, because it means that there's potential for it to creep up and catch up to Ottawa.
Yeah.
So I kind of like those markets. I know it'll never be Ottawa, but if those rents creep up and catch up to Ottawa because people are tapped out in their budget and can't afford it, well, they'll cross right over. And
Yeah.
Talk to us about it, Alex, because I heard about a premium when you want to build in Gatineau because you are close to Ottawa. Are you seeing that in your project, being charged a premium compared to Sherbrooke or compared to Quebec, for example?
I couldn't speak on behalf of all the regions of Quebec just to build, but I probed around, made a few calls to guys who build in Montreal, but the cost that I was getting to build, or the price of land, the price of construction in Gatineau versus Montreal, was somewhat comparable. Actually, I was told that what I was buying made sense, like from a big developer in Montreal. Relative to Sherbrooke, Trois-Rivières, like secondary, tertiary markets, I couldn't tell you, but I don't think there's a premium per se. I just think the premium is factored into the cost in the sense that rents are high, so they can get away with selling it for that price because they know the numbers work at that amount. Land is quite costly there. It's not free anymore, but the margins that they make, like the spread that they're going to make, I think they're making a healthy spread, a healthy margin.
Yeah, and it's all a ripple effect because if your rent ultimately as a corporation is like higher, then ultimately that reflects in the price. So, and rents in Gatineau are pretty comparable to Montreal, I would assume.
Pretty much
It's
identical.
like maybe Longueuil
yeah.
on the new build.
They've creeped up a lot though in the last in the last
And I mean, a couple of weeks ago,
3 years, I would say.
I was in Ottawa and I had someone bluntly told me, like, oh no, I moved to Gatineau because I just couldn't afford it in Ottawa.
Yeah.
I actually thought about you, but no, that's,
Well, that's where the opportunity
They just
Yeah,
cross
that's
the
it.
bridge.
yeah, they just cross the bridge, exactly.
And I create pockets of opportunity because you basically pricing your rent on the other side, but you're buying the land on this side.
Yeah.
And
Most
right
smart
now, like people were actually, they were working in Quebec, living in Ottawa because the income tax was lower in Ontario. It's almost like at par right now. You don't really have that much of an advantage. So if you're going to work in Ottawa and then like government job or just Ottawa and then move to Quebec and pay your income tax in Quebec, you're probably going to be in a better position living in Quebec if your rent is $1,000 a month.
And the other
less.
point
So
about Gatineau that's interesting, like we're going to close the deal on Gatineau, but the
Clearly.
the kindergartens are c'est garderie in
Yeah.
so kindergartens are $7 in Quebec, while as in Ottawa is just so much more expensive. So all the families are moving to Gatineau right now.
So that was a business case on investing in Gatineau.
yeah. And maybe in kindergartens.
maybe they'll enroll a new program too. I don't know. If you have a certain amount of
Well, 30% square footage is accepted
Is
under the
accepted.
CMHC.
okay. Yeah. I was gonna say maybe if a percentage of the people you rent to have young families, they'll add you on the grid.
Yeah.
Maybe
wow.
that'll be an extension to our MLI in 2024,
30% commercial.
5, and 6. No.
So talking about what they're going to add and what's going to change, like let's talk a little bit about 2023 because it's now like literally days away. So
I'm already in 2024. I mean,
No,
Yeah,
no,
like
no, no.
literally
Slow
in my
down.
head.
Slow
I'm
down.
already like
Yeah, you're already at end of 2024. No. So 2023 is days away. What do you guys? Where are you at? And I have a little bit to share, like on my project, but I'd love to hear where you're at. Uriel, you want to start?
Yeah, so 2023 will be, I will really focus on my my project in Lévis. So are you asking about where the market is going or about what we'll be doing?
Both.
Okay. I truly believe, and this is not biased, that the rate will drop even more. They have already dropped I'm currently seeing something really weird, and I don't want to get too technical, but the CMB that is really matter for us when we invest in multifamily, usually you have your 5 years who's below your 10 years. And right now there's something really odd. They're almost at par. So what that tells me is that people are not really confident when it comes to the future. Those lending money to those who are lending money to us. But at the same time, I'm convinced the rate will decrease even more, because at some point, if you want your economy to be able to prosper, to grow, you have to decrease the rate so that people can borrow money at a cheaper rate so that they can, restart the economy.
Yeah.
And we need that.
Well, it's already pricing in. If you look at it, I'm getting some quotes in money. Like if I'm forward fixing for, May, June, July, November of next year, it's kind of already priced in there that no one's really talking about and people don't quite grasp. So, and then you're looking at short money, 2 year, 5 year versus 10, which is completely inverted. The curves are completely inverted. So they're anticipating and projecting a reversal of these rates.
Yeah.
That's a projection. It's not a guarantee. But to your point, I think you're smack on correct. I think next year we'll be able to get 5 year money in the low to mid threes. I don't think we'll be ever back at 1.5 we were. But
they will decrease. And because I'm in the phase where I'm working on getting the permit, working with the city to get the project fully approved, focusing on that, starting the construction hopefully by end of next year. That will be my main thing next year.
Interesting. So, on my end, I'm hoping, but let's not be hopeful. I think to me, they got to get inflation under control. And then once we see that happening, then, we have chances of seeing rates going down. But up until that's not under control, I'm a bit, I'm going to see as it goes. But to add to Alex's point, we're seeing that it's already priced in terms of rates right now. So we used to have hedge costs, which is when you fix in advance your rate, that were 20, 30, sometimes 40, 50 basis points. And now we're talking for 3 months is 7-8 basis points, So obviously they're not anticipating crazy rate increases. But who could have predicted the war in Ukraine? So it's still a very complex, I think, geopolitical environment. So let's hope it's a bit more under control. But I think continue to stress test and use today's numbers in order to project and add a lot of buffer in there is just going to be the new reality for anybody who is hoping to build these days, and to just make sure that they're not too stressed. In terms of me, I'm going to have my biggest year. I feel every year I'm it's going to be my biggest year. And then it's just always, the next one's always bigger. So it should be a very exciting year. It is making me a bit nervous because it's big investments. It's huge.
Your biggest year in terms of what? In terms of l'effet papillon or your investments on the side?
Personal investments, yeah.
Good.
Yeah.
Congratulations.
So,
it might be her best year on both,
Even better. It's okay. We'll see next year.
They go hand in hand.
Yeah.
Exactly. Hopefully Effet Papillon's been doing well this year, so we're going to hope that it continues in that sense, and I'm not worried. But in terms of personal investment, it's going to be a big one. So I'm excited, but it's still a bit scary too.
Just want to say something. You mentioned something about the war and the geopolitical, environment. I think what really hurt us this year is not so much, I think, the increase itself, but the volatility. The fact that the rate was just going up and down, up and down, up and down. And that's what makes it really hard to plan ahead for banks, but also for us at the end of the day. Yeah. So,
what you can do in that case, and that's what I like to do, is forward fix. And if there's a drop in the rate, you forward fix and lock. It does come with other challenges, because if you don't use the rate, you can be penalized, and you can have a rate go back even lower, so you don't want to lock in too soon. But it's a little bit of a yo-yo, but I feel it's a tool that can be used to mitigate such volatility. And for me, when I see those rates, I'm I need that rate for this project to be viable. Let me lock it in. Let me make sure it happens.
Can you just explain how this works?
I can add to that,
please.
We're kings and queens of that. Let's
Stephanie's
talk about
the expert of that.
And especially for those that are listening, because it's important to mention that it's one of the things I wanted to mention actually is just don't wait to get everything aligned for your financing. The earlier, the better. I would suggest even 6 months in advance is not enough sometimes, depending on the scale of the project, to get your financing in place. And the sooner you get it in place, the more flexibility you have with rate forward fixing. So that depends also. Not everybody does it. It's just specific lenders who do it. There's one that'll do it before the CMHC certificate is issued, but most of them will wait until the CMHC certificate is issued. So the best advice I can give you is do it as early as possible, so you have the flexibility to take advantage of the volatility in the market. Just be prepared as soon as possible.
Risk management, because sometimes you will be able to fix the rate. The way I look at it, I currently have a project where we have the certificate from CMHC, and it's my recollection, I think it's 4.4 something. And the thing is, you don't want to do it also too early, right? Because if you do it too early and then the rate drops, then you just left a lot of money on the table. However, I think from a risk management perspective, especially if you want to refi and put some money out, if you can make sure that the rate that you are locking makes sense for you and works with your number, sometimes don't try to be too greedy, right?
Yeah.
Because don't forget, you can always refinance 5 years after, right? Or 10 years based on how you structure your financing. But sometimes taking that percentage right away is more healthy than dragging too long, because then you get hit by a higher rate afterward, and then you have to put more money on the table.
Mm-hmm. That's a really good point. I kind of wish I had remembered that a little while ago.
And there's no perfect rate and file and when am I going to lock? Do I lock 3? Do I lock 5? I'm always like, oh, I wish I would have done that.
Yeah.
But then everyone wishes they could have done something in the past, and everything is so easy to say after the fact. When we were looking at rates at 119, I locked up a big dossier at 119. I'm like, oh, why didn't I just lock up 5 years? I would have saved almost $100,000 a year of interest alone. But then on the flip side of the equation, I'm like, yeah, but had I done that, I wouldn't have been able to refi and take out 500 or 600K, which I've repivoted into another project. Mm-hmm. So like, you're almost calculating, is it better to take out to do another project, or, I would have been paying a substantial amount more. I am paying a substantial amount more interest. It's always like,
what's the real today's reality, and just stop the wishful thinking. What is it today? And let me adjust based on today's day and age.
And don't worry about what you didn't do in the past, because no one
works for your project. I mean,
and actually, this is the perfect segue. Like, we've all done some good deals and more questionable deals in 2022, and I was hoping like we could all share. I don't want to call it a screw up. We'll just call it a major learning experience. So, who would like to start?
Oh.
Okay, I'll start. What did I do that I would do differently? There's 2 projects I can think of. One, I made a mistake. It sounds like a small mistake, but it actually cost us about 6 months to be able to start. I kind of cheapened out for a building permit. It's a renovation of a 4-plex in Laval. And I had the choice, to get the plans, to get a dessinateur or an architect. And I went with a dessinateur because it was cheaper. And it actually ended up costing us 6 months wait, because it took us 9 months to get our building permit instead of 3 months. And that's one of the major things I've learned. And so now I do differently in terms of like, spend more at the beginning, get a good team of professional, and you'll actually save money even though it's more expensive up front. Small mistake, big consequences. We actually got the permit now, and we're starting the work. The reno, it's about like three months of renovation. So we'll get it done for targeted April, May. Is just that we were hoping originally to be finished in July 2020. So just 2022. So just putting it back in perspective. It's okay.
I'm next. So I bought a building. It was 11-plex. And usually when I buy a building, I always ask for phase 1, phase 2, and whatever. And I did have a phase 1. I did have the phase 2, which was clean, no issues on it. And the challenge was about 9 years, something like that. So it was okay with the bank when I bought the building. But now when I'm refinancing, the bank is no longer okay with it. So I did again a phase 1, which was okay. But then the phase 1, the company is basically saying, well, there was something missing in the previous phase 1. So I have to call the person I bought the building from, who isn't the one who did that study. So I had to go back to the person before that person who was no longer in business, who was actually in bad term with the company they did a phase one with. So the company doesn't want to give me that phase one or any report as a matter of. So I had to go through the process again and do a phase two again. So my biggest lesson learned is, especially now, because I think now we have more flexibility with sellers, is no matter how old is the phase one or phase two I'm getting from a seller, I will redo it myself as part of the buying process. It was kind of hard in the past to include that because sellers, they had so many options. Now that's why I'm also happy about the way the market is kind of shifting, because now I think the relationship between buyers and sellers are more balanced. There's more nuances and more conversation that can happen compared to in the past where it was just like, what is your number? Take it or leave it or bye-bye, right? Yeah. So that's really something I learned from this process is, yes, he's wanting to get a phase one and phase two from the seller, if it's an existing one. But what I used to do is always get also a letter saying, okay, you give me that phase one and that phase two. If ever I need more information, give me a letter that allow me right away to be able to get those information from whoever you did those phase with. Now I'm going one step further and completely redoing my phase one right away as part of the buying process. That's really the lesson learned.
And you feel like you can always justify the extra 10K expense?
It's not a really 10K. I mean, a phase one, you can anywhere between 2 to 5K, you can have one. So
yeah,
I think
but if you need a phase two, then you are at 10K.
Well, but then that's actually good news if I need a phase two, because that 10K, trust me, I'm not paying for it.
Leverage for negotiation.
Exactly.
Exactly.
Yeah.
That's an interesting question. I would say make as many mistakes as possible. Just don't do them again. Not the same ones, at least. I think that's the best lessons learned are through my mistakes, So just the goal is don't make them again. Once you've did them, learn, take everything you need from them, and then grow from them. I think it's just, if you're not doing any mistakes, you're not doing anything in your life. So like be perfectly imperfect, and that's okay to embrace that. In terms of my personal mistakes, I would say like not getting more doors as early as possible. I was in the market when I was 20. I bought my first building when I was about 22. But yeah, getting more doors earlier, but now like it's lesson learned. But
you also didn't have faster. The MLI back then to help
exactly,
you out.
But moving faster, I think too, like real estate was not necessarily like investment was not necessarily my core business because it's always been brokerage, but yeah, being into the market faster and quicker as soon as possible. So
that's a good one.
On my end, I mean, I took the bet that rates wouldn't climb this high this fast, and I have a couple condos that are all held variable, but I took that decision that, long-term variable would always outperform fixed. It really sucks right now. Like you look at it and you're like, I'm just servicing like interest right now. So yeah, I made that bet that, it wouldn't go up and it wouldn't go up, and they promised us that rates would stay low and they didn't. And, never take prends jamais ça pour acquis is kind of what I learned. And so my biggest mistake this year was, I bet rates wouldn't climb as fast and high as they did.
I'm always having that conversation with my wife.
I was going to say, can we please talk about the fixed versus variable? Because we've all had that debate. And on my side, I've always gone fixed with everything. And I know technically overall it underperforms variable. But if you look at 100 years, I've never invested for 100 years. I invest for 5 years at a time. So I've just taken a fix because then I can sleep at night. How are you guys? What's your choice?
I'm so sold on variable. So I have a small place.
But look at him now.
So am I. I mean,
yeah, look at him. Now he's eating his pants.
It sucks.
I'm still. I was paying, I think, 1,600 for a duplex I bought a long time ago, and that I live in actually. And my wife was like, "We gotta go fix. I got this, baby. I'm the one."
She's kicking you now.
I know about real estate. I'm a pro. That's what I do for a living. We're gonna stay on variable. I'm not cocky. I'm no more. Those conversations are a little bit harder to have. But honestly, I think on the long term, I'm doing something really good because now we went from 1,600 to 2,300. I'm not going to die because of it, even if that hurt, because you are basically, like you said, you are servicing debt. That's the only thing you are doing. It was funny. My wife was looking at the account and she saw like What happened? Last month we owe 400,000. Now it's still 399. What happened? Like usually it goes lower faster. Yeah, the rate kind of went high, so that's why,
And every month that goes by, it's worse. Rather not to look at it.
You're like, let me take control of the account.
That's what I need. Let me take care of that account. Don't look at it.
Request e-statements. Request e-statements.
Okay, then I have another question for you. In April 2023, I'm supposed to renew mortgage on a condo. I have about a $200K debt on it.
Variable.
What would you do?
Variable. Especially now, you do not want to make...
Okay, on a 2-year term or on a 5-year term?
Shortest as possible. 1 year.
Okay, because I was going to go 2 years fixed.
1 year. 1 year variable.
No, 1 year they won't do.
It can't get worse, right? I'm making the bet it can't get worse. Even if it get worse, you don't want to lock a rate now for 5 years.
No, definitely.
What,
I'll only do a 2-year term, and I was going to, anyways, we'll see.
Now, I just want to I want to make a caveat. So I'm going variable, but also I'm putting money on the side, right? So I'm like, I have a backup plan if things go bad. So that's what it comes down to, being comfortable with the risk level that you are taking. Variable seems more risky, but I really believe on the long term it's cheaper. So if you are not comfortable, go variable, but put money on the side just in case something goes bad. But I will go 100% variable today.
Okay, good to know. Good to know.
What about you guys?
Yeah, I think there's a nuance that it's worth mentioning is that, we're talking about duplexes, triplexes, like it makes sense to go variable on those. But I think for the large scale development projects, you'll never see a large scale development project on a variable rate. So I think it depends on the type of investor. It depends on your objectives as an investor and your level of risk. And at the end of the day, I think what, as you said, is putting money aside for the rainy days and just making sure that you have enough on the side, knowing that it won't last forever. But I think it's important to notice that there's a nuance between somebody who invests in a duplex or triplex or condos versus, 30, 50 unit building.
That's funny because even on my multifamily, the one that went from 1.95 to 7.1.
Where are you getting 7% though? I'm just curious.
National Bank.
I can find you better than that. I'm not even a broker. I mean,
no, this is what's happening. The loan expired last month, and I'm planning on putting a long-term debt CMHC insured MLI Select on it. So I just, pursue the current loan.
Oh, it's like an open mortgage.
Exactly, open mortgage. Okay. So that's why. And trust me, they didn't make me any favor.
No doubt. Oh, man.
So even there, like I'm going variable because I know I'm going to be putting a long-term debt, like insured, really soon on it. That's why.
But it's not like for the multi-unit large-scale projects, it's not a long-term strategy. I think it's a shorter-term strategy that's really good. It depends on who you are as an investor and what your risk level
All
is.
I can say is like the CMHC government insured program, like they have their ducks aligned. They've done their due dil on the program just because of the fact that you can't do the program with a variable rate. And thank goodness that that's in place because the whole system would be,
could collapse.
In a dire,
All right, we're getting towards the end here. 1 minute to close, and I'm just going to come up with a random question that you guys don't know about. Is basically, what could we wish each other for 2023? Wish each other.
Lower rates. Happiness. I think we being a real estate investor is something. It's really special. Like you go through so many highs and through so many lows, but that's where you learn the most. So I would say the stamina and the mental toughness to go through all those steps. That's what I would wish to everybody around this table, but also everybody listening to this podcast. Mental toughness.
Mental toughness, and it's funny you say that because as I was asking, I was like, what am I going to say? And the thing is that as real estate investor is tough, and I would wish everybody to never forget why they're doing it, because it's so easy to get caught up in the race, in the race for doors, the race for this, the race for that, and more. And we had this conversation with my wife where originally we wanted to get our time back to spend more time with the kids. And at the same time, now it's like we keep piling on projects and we're like, oh, we did exactly what we didn't want to do. So what I wish all of you is to realign on why you're doing this.
It's a great statement. Thanks, Axel. What I wish everyone is more freedom. Honestly, we, as entrepreneurs in the real estate space, I think a lot of us do this for that freedom. We don't have that 9 to 5 commitment, or we have the cash flow. We can, buy more. We can say, you know what, this year I'm not interested in buying more. I just want to travel.
Yep.
I'm going to use that to travel. I'm going to use that refi to, do something else. And
According to
You're not
CMHC
supposed to.
You're not
standards.
supposed to.
You're not supposed to.
on a side note, I'm talking about residential mortgages.
Nice save.
was
Nice
like,
save,
I
Stephanie.
wish everyone more freedom in
Cut,
travel.
cut.
Of course, he is reinvesting
That
it.
was a good one.
On this note,
I
Stephanie.
wish everyone next year
On this note, Stephanie, what do you want to use your refi for?
more laughs and humor.
So we're going conventional.
Yeah.
Celebrate the wins, no matter
Yeah.
how little, on the personal side or the business side, wherever, the little win. I just want to say there's a beautiful sunset in the back of Axel. Let's celebrate the beautiful sunset. And celebrate the little things.
Yeah. Very good point. And now, as much as you've all been on the podcast before, where can people find out more about you, starting with Alex?
Prince of Pre-Construction, find me at Alex Rossi 6 on Instagram, and you can connect with me on LinkedIn, Alexander Rossi, for a more professional network.
Yay.
Same thing, LinkedIn, Stephanie Kowalew. You can find me on LinkedIn.
Uriel Bigot on all platforms, YouTube, LinkedIn, Facebook, and Instagram.
And I will make sure we put it all in the show notes. I'm not going to tell you where you can find me because you're already listening. So thank you very much. There is just one thing that was said that I think is going to be my closing statement is that, before I get to that, all three of us have been able to do what we do because we've also invested in ourselves and educated ourselves, and that's really important. So if you're listening to this, go to the next step, read books, listen to podcasts, take some training. You'll never regret it. And as Stephanie said, you can do all the mistakes, but you can only do them once. I really like that. Keep making offers, research your market, and we'll talk next week. Thank you for tuning in. Ciao.
Thank you.